Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Paris Rapeseed. In December last year, prices overshot the targets on the downside for the small double top pattern formed over October and November 2025. That had been capped by the dark blue neckline extension, currently 484 1/4, of the August to September 2024 reverse head and shoulders bottom. They dropped down below the bright red neckline extension, currently at 447 1/2, and that's to the May to August 2025 head and shoulders top. But in doing so, the bearish incentive had been eroded enough. That congestion at the 50% absolute Fibonacci line, which is at 445 1/2, almost stopped it. And then the March and April 2013 highs just below at 442 and 441 1/4 respectively did stop it and turn prices higher. The subsequent rise created a November to 25 to January 26 diving board pattern, where from a fairly flat area the market dives down as if in a swimming pool and then pulls back out and up of the pool. We have pulled up and out of that pool and reached the pullback target area in the 472 1/4, 472 1/2 area 2 weeks ago, pushing up over both the green short medium moving average, currently 467 3/4, and the mauve medium moving average, currently 469 even, but got capped by the combination of flatlining long moving average, currently 475 3/4. Now, a diving board pattern is a bullish reversal pattern, so the opportunity for higher prices is still there and something to watch out for, especially as the second part of the combination has been a changeover gap that left a gap between 457 3/4 and 471. Not the widest I've seen here, but quite wide. We have since the gap last weekend recovered a considerable part of it. But we are coming back up to that same pair of green short medium moving average plus the mauve medium moving average, along with the other congestion that I hadn't mentioned earlier, and that's between 467 1/4 to 468 3/4, made up from the 50% Fibonacci on the May 23 to January 25 move and the June 2021 low respectively. Question now is the same as last week. What's next? Well, the overhead gold long moving average is still, to me, the key immediate obstacle. And then beyond this, the dark blue neckline extension. I would say they are both significant, if not formidable, with a more heavier emphasis on the dark blue neckline. Looking below, well, we could try going lower, but the market has done that, been down there recently twice, and didn't like it. However, please keep an eye on the bright red neckline extension should we try lower. Winnipeg Canola. The key recent patterns here had been formed from the fairly extraordinarily flatlining gold long moving average, which is currently at 663.40. It was a small November and early December base double top, with the market subsequently crashing down through all the supports and targets for this small pattern below. Down through, and I added this 7 weeks ago, and I quote, "It looks like the 50% absolute Fibonacci line at 606.90 is not going to stop the decline, in which case we could next be looking at congestion at 575. It all now depends on the 606.90 50% absolute Fibonacci line can hold." End of quote. In truth, the 50% absolute Fibonacci line did not hold the market, but it did erode the bearishness enough that we formed a small double bottom pattern over the end of December last year and the start of January this year. The move up since the formation of that small double top reached up to both the primary, double bottom, reached up to the primary and secondary targets topside, and has this week overcome the key combination, the June 2021 low at 655.90, and the 50% Fibonacci line for the 2025 move at 655.70, as well as yesterday, the same flatlining gold long moving average further above. Now, further above is what may be, in some ways, an additional cause to the capping we saw late last year, and that's the significant bright green April to August head and shoulders top neckline, which is currently 686.70. Will the market this time push up through these resistances? Well, I'm not too sure, but given what I've witnessed elsewhere, including here, of a possible weekly key reversal this week, thus, if prices close on Friday night either over 662.60 or under 659.20, then we'll be on. Anything in between will have a lesser outside weak pattern. Right now, we're looking at a weekly key reversal up. Given this potentiality, plus the possibility that the late December last year today action could be a possible bullish halfway hesitation, well, it does look ominous for a test up to the bright green neckline and beyond, maybe through the 50% Fibonacci line of the July 23 to September 24 move at 700.30. Finally, I also thought we might have a possible bow tie formation, the short, medium and medium moving averages early last week, but I am inclined today not to view it so, and we will leave that as an idea for now. Bursa Malaysia crude palm oil. To start with, as I have done for most of last year, I'd recognise the wide congestion band that's overhead between 44.08 to 45.59. We tried in mid-October last year to pierce it and failed, with prices punching down through the lower edge of this congestion, as well as most of the moving averages for quite some time. On the way down, prices dropped down through a wide congestion zone, made up from the 38.2% Fibonacci of the May 20 to March 22 move, and a 50% Fibonacci of the May 23 to December 24 move, based around, both at the same level, 42.74. This is an important area, so please remember it. Then there's the 38.2% Fibonacci line, the July 19 to March 22 move at 42.39, and July 23 high at 41.89, and into a free area, where the market created a small diamond continuation pattern. More on this one shortly. You see, the recent overall pattern had been the mid-August to early October bearish Andrews pitchfork. They had been pretty good at leading prices lower until we reached three bands of congestion. The lesser Fibonacci line at 40.26, further congestion at 39.86, and the February 2011 high at 39.53. I suppose in the big picture you could also include the neckline extension that slashes across my daily chart of the late May to April 24 small reverse head and shoulders bond, which is currently at 38.31. I know the prior three eroded the bearishness of the market as it travelled through it, so I suppose this one also played a small role. Anyway, the move lower within the bearish Andrews pitchfork was fine until two things occurred. The first is the construction of what can be seen as a triple or even a quadruple bottom over November to date period, though I'm more inclined to look at it as a very, very complex reverse head and shoulders bottom. Now, this is a subjective judgment. I realise that, but I stand by that. This pattern came of the previously mentioned November to early December diamond continuation pattern. This came out of it. The second occurrence happened with prices breaking higher from this complex reverse head and shoulders bottom, and out over the upper tine of the bearish Andrews pitchfork. The market's earlier actions preclude me finessing this to a shallower bear shift pitchfork, so it's very much goodbye after today to this bearish Andrews pitchfork. Goodbye. Prices then moved higher, pushing somewhat easily through the wide overhead congestion band previously mentioned between 41.89 to 42.74, as well as the gold long and mauve medium moving averages. In the process of moving higher, the market reached the primary and secondary targets for the complex reverse head and shoulders bottom of a primary target X, 42.47 area, as well as the harder to reach target X1 in the 43.07 area. That happened last week. However, as soon as these targets were reached, the market dropped down to comfortable support of the gold long moving average and just under the mauve medium moving average. For all the life of me, it looks as if this market may have, temporarily at least, spent its energy on the upside, but has no desire to move lower just yet. And this is what most of the other veg oil and oilseed markets looking to form, and this is actually with most of the other veg oil and oilseeds markets looking to form possible weekly key reversals. We don't have one here. Thus, I think I will watch and see what the next pattern here may be developing for now. because it could be quite interesting.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.